Hello, my name is Lorien Stice-Lawrence. I'm an assistant professor of accounting at USC's Marshall School of Business, and I'm here to give you my Tommy Talk entitled Words, 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 How Emerging Technologies Can Help Us Harness the Power of Text. Now, I'm going to begin my talk by giving you some accounting background. Don't worry, this part won't last long. Then I'm going to talk to you about how we can use emerging technologies to use the enormous amount of textual information that is available to us today. At a high level, accounting is a way of recording the financial transactions of a business. An important role of accounting is to communicate with people outside of the firm to give them a sense of how well the company is doing. We call this financial accounting. Individuals care about understanding a company's financial well-being because it can help them make good investment decisions, pick good firms to work for, and decide who to do business with. When you hear people talk about accounting information in the news, most of the attention is going to go to the four financial statements: the income statement, the balance sheet, the statement of cash flows, and the statement of stockholders' equity. And often this will be boiled down to one number, net income. Usually people talk about this in terms of earnings per share, or EPS. This is the sort of thing that makes headlines. Microsoft EPS shows strong gains, or ExxonMobil's EPS tanks after low energy demands. But even though these simple numbers get all of the press, there's a lot more information that firms share that can't really be boiled down into a few numbers or often into any numbers at all. That's because a lot of information isn't cut and dried enough to be condensed into an earnings number. Firms often have a lot of information about their current and future operations that would be valuable to investors, but which doesn't affect current accounting numbers. The good news is that they can still share this information with those outside of the firm. Securities regulators such as the SEC, or Securities and Exchange Commission in the US, require firms to provide written disclosures along with their basic financial statements. In addition, firms can also provide information through press releases, conference calls, their websites, or even tweets. For example, did you know that firms have to tell you what they perceive the greatest risks of their business to be? There's no need to twist their arm. You can look it up in their annual report and see for yourself. For example, in their 2020 annual report, Google's parent company Alphabet listed both ad blocking software and natural disasters as significant threats to their future profitability. So, what does any of this have to do with emerging technologies? I can tell at this point you're thinking that I lured you in with interesting buzzwords only to trick you into an accounting lecture. Well, here's the thing. Companies are disclosing a lot of information. In recent years, the average length of annual reports filed with the SEC was 60,000 words. That's about 120 pages, or twice as long as Shakespeare's Hamlet. Yikes! Compare that to 1996, the first year that firms started filing electronic reports with the SEC, when the average report was only about 30,000 words. That means report length has more than doubled. And don't forget that firms also now issue more press releases and hold more conference calls and make more tweets. The problem that users of financial information are running into now is one of information overload. Too much information. Overwhelmed with so much information, it might be easiest to just stick to the basic accounting numbers and ignore all of this cumbersome text. But don't give up. The good news is that as the amount of available information has increased, so have our technological capabilities. Gone are the days of dial-up and pagers. Now we have things like big data and artificial intelligence, and we can use those to help us make sense of all of this information. So, how have researchers and practitioners used these emerging technologies to address this exploding volume of information? In the early days, they kept it simple. For example, if you just count up the number of positive and negative words in a document, you can get a measure of its tone. Early work showed that even simple positive and negative word counts are linked to things like stock returns and volatility. Basically, even after looking at the financial accounting numbers, firms provide information about their economic outlook just in how they talk about their performance. Algorithmic traders immediately started using these techniques to analyze and trade on the information contained in written documents faster than it would be possible for a human to actually read and process them. Of course, this can be a double-edged sword. In April 2013, the Associated Press's Twitter account was hacked and released a tweet saying that the White House had been bombed and President Obama had been injured. Predetermined algorithms picked out the negative words in the tweet, and the market took a nosedive within seconds. Of course, eventually, some actual humans took the time to see whether the tweet was substantiated, and the Associated Press eventually removed the tweet, and the whole market rebounded, all within the space of about 6 minutes. Such volatile market swings are much more likely to happen when we're dealing with computerized decisions. Of course, there's much more that you can do now than just have a computer count words from a list. For example, remember when I said that firms' annual reports have doubled in length over time? Well, it turns out that no one could quite agree about why this was happening. U.S. firms pointed the finger at regulators and accused them of saddling firms with cumbersome disclosure requirements. Regulators pointed the finger right back and accused firms of filling their annual reports with fluff and legalese. In order to settle this debate, my colleagues and I used machine learning to identify 150 topics discussed in annual reports and examine whether there have been changes over time in how frequently firms discuss any of these topics. For the most part, firms tend to talk about things now about as much as they did in the past, but a small group of topics accounted for virtually all of the observed increase in report lengths. When we dug into the 3 topics that were driving these increases in length, we discovered that each was mandated by a new rule or regulation, in particular rules requiring them to provide information on how they value assets, measures to prevent fraud, and risk factors. So annual reports haven't been getting longer because firms are filling them with garbage. They've gotten longer because firms are now required to disclose more things. A natural question is whether these new disclosures are actually useful. If we use risk factor disclosures as an example, we can again use textual analysis to answer our question. Researchers have shown that stock prices tend to respond to risk factor disclosures, indicating that they provide new information to investors, and they are predictably associated with volatility, a reasonable measure of risk. They have also used automated techniques to show that more specific risk factor disclosures are more useful. So it looks like these risk factor disclosures are pretty great after all. More generally, we see that automated techniques can extract meaningful information from text that would be virtually impossible for an individual to do by hand. What else can we do with these techniques? Well, to put it quite simply, if you have any sort of text, you can analyze it. From company reports to product reviews to press articles, the sky is the limit. There is an enormous amount of information out there. You just need to decide what your question is, and you can probably find some text that can answer it. Another example of how I have used textual analysis is to examine the effects that translation choices have on investors. As investors look farther and farther abroad in search of new investments, and companies engage in more transactions with their international counterparts, things like language barriers are becoming more and more relevant. In order to examine this, we studied Chinese companies that issue reports in both Chinese and English. As I've mentioned before, firms provide a lot of information in their corporate disclosures, but what happens when different investors have access to different information? Let's say we have 2 investors, one who only speaks Chinese and one who only speaks English. If a company issues 2 versions of the same report, one in Chinese and one in English, then the Chinese-speaking investor will read the Chinese report, and the English-speaking investor will read the English report. If these 2 reports contain absolutely identical information, then both investors have the exact same information at the exact same time. There's no information advantage one way or another. Now let's say that the English report provides additional details about an acquisition that the company is thinking about making. This could be potentially important information. In that case, after our Chinese-speaking and English-speaking investor have read the report in their native languages, they will each have a different set of information. Why would this matter? Well, let's say that the additional information has convinced the English-speaking investor that the company's upcoming acquisition is not such a good idea, and they decide to sell their shares. The Chinese-speaking investor does not have this information, so they hold on to their shares. Now, the information that the English-speaking investor has will eventually come out, but by the time the Chinese-speaking investor has learned the news, the price is lower, and they've lost their chance to sell their stock at a higher price. This issue is referred to as information asymmetry, where one set of investors has access to information that another set does not. This is exactly why many securities laws require companies to disclose information to all of their investors equally so that no one is at an advantage over everyone else. You might be asking yourself, why don't both investors just translate the other language report themselves to make sure they have all the information in both reports? The problem is that translating reports takes a while. Remember that they can be hundreds of pages long. By the time the Chinese-speaking investor in our example translates the information about the acquisition, the English-speaking investor has already traded on it. Of course, the example that I've just given you is a simple hypothetical. Is this really an issue in the real world? In order to test whether this is the case, my colleagues and I used our handy-dandy machine learning skills to analyze differences in the content of the Chinese and English translations of the same report. Just like when we analyzed the topics in U.S. annual reports, we used a computer model to analyze the content in the annual reports of Chinese firms and identify the different topics discussed. The difference this time is that we are now dealing with content in both Chinese and English, so the topics we identify contain a mixture of Chinese and English. Wait, no, we can't analyze two languages at once. We'll confuse the computer. Its circuits will melt, and then where will we be? Luckily, machine learning algorithms don't rely on the language of the text that they are analyzing. In fact, the same type of machine learning algorithms that I use to categorize text documents have also been used to categorize images based on pixel patterns. So that's how Google knows how to find all those cat pictures. If Chinese and English translations of the same document have identical content, then we should find the same proportions of all topics in both languages. But we don't find that is the case. In fact, we find quite a few differences in the Chinese and English translations of the same report. For example, Chinese documents have more discussion of firm performance, whereas the English versions of the same report have more discussion of strategy and leadership. But do these differences actually matter? And more importantly, do any of them appear to be intentional, as opposed to average differences that we would expect anytime we have to translate? When we look at the types of firms that tend to have larger translation differences, unsurprisingly, we see that these differences tend to be larger for smaller firms and in cases when the translation isn't legally binding. However, one surprising finding is that we find greater disclosure differences for Chinese firms which receive subsidies from the Chinese government. Now, there are a lot of things at play here, but one simple explanation for this is that when the government is a relatively more important stakeholder, the firm is less concerned with taking care of the information needs of its remaining stakeholders, including providing a high-quality English translation. So, we found some evidence that this measure of translation differences appears to be capturing some intentional choices by the firm. But remember that the reason why we expected this to matter in the first place was because we think it will lead to differences in the information available to different sets of investors, information asymmetry, and thus how they choose to trade. How can we actually measure that in the real world? One way is to look at stock liquidity. To put it simply, when there's a lot of information asymmetry in the market, everyone is afraid to trade with everyone else because they're afraid that others have better information than they do. As a result, it becomes more expensive to convince other people to trade with you. We refer to this as low stock liquidity. For example, in an extreme case where no one has the same information, if I have information that leads me to sell a bunch of shares in a company's stock, as soon as everyone else in the market sees I'm trying to unload shares, they are convinced that I have bad information and immediately drop the price that they are willing to let me sell at. In contrast, when everyone knows the same thing, you don't gain any information from seeing how others trade, so prices don't respond to trades. In our study, we think the translation differences that we are capturing will lead to information asymmetry when the reports are released. As a result, we expect stock liquidity to decrease for firms with reports with large translation differences. So what do we actually find? Well, it turns out that bigger translation differences are associated with greater information asymmetry. In other words, when there is a greater difference in the content of the Chinese and English reports, investors have a harder time agreeing on the firm's price, and there is lower stock liquidity. Our setting is especially interesting because the stock of Chinese firms can be traded on multiple exchanges that cater to different sets of investors. When we look at stocks of Chinese companies traded on Chinese exchanges, where, for the most part, only Chinese citizens who speak Chinese can own these shares, we find no evidence that translation differences matter. Because all of these investors speak the same language, Chinese, they all use the same report and translation differences don't matter. However, when we look at stocks of Chinese companies traded on the Hong Kong Stock Exchange, where investors from all over the world, including both Chinese and English-speaking investors, can trade in the stock, we find that translation differences do have a significant effect on stock liquidity. This means that when you have a mix of investors speaking different languages, translation differences make a big difference. Now, why does this matter? Well, in spite of the fact that the world is much more interconnected now than it was even 10 years ago, there are still a lot of barriers to investing globally. Remember, at the beginning of this talk, I told you that we now have more information available, in particular textual information, than ever before. But simple things like language differences can still affect who actually gets this information. Emerging technologies that leverage the power of text can help investors overcome language differences by allowing them to use algorithmic trading based on text documents, even if they can't personally read them. But they can also help researchers like me quantify the extent to which these barriers still matter by objectively studying disclosures and quantifying their content. Machine learning and other emerging technologies can help us make evidence-informed decisions, whether it's settling a debate on who's to blame for long disclosures, or measuring whether language barriers are a hindrance to investors and why. Now, you may not be up for implementing some of these technologies yourself, but that doesn't mean you aren't affected by them. When you wonder how prices react so quickly to press releases, remember, machine learning enables investors to synthesize documents more quickly. When you wonder how the SEC was able to catch a fraudulent firm, remember they can use algorithms to flag suspicious documents. And when you wonder whether anyone is actually using all of those product reviews you've been writing, just remember that machine learning can give companies the big picture that reading them individually might not. Thanks for listening to my Tommy Talk, and fight on.